All right, CFA Warriors. So, level 3, This is it. The final boss of the CFA exams. Level 3 is where things get real. You've conquered the grind of levels 1 and 2, but now it's not just about knowing the material, it's about applying it like a pro. Unlike the previous levels, this exam is a mix of essay style, constructed response questions, and item set questions. Yeah, that's right, no more clear-cut multiple choice. Here, you'll be crafting responses, structuring your thoughts, and proving you can handle the big leagues. Before we get started, these summaries you're seeing on screen, these are FinQuiz battle-ready summaries. They've helped thousands of candidates simplify the madness and study smarter, not harder. Think of them as your secret weapon for tackling this beast of an exam. So print them, highlight them, scribble notes on them, whatever helps you absorb the material like a pro. These summaries are designed for last-minute review, laid out in an easy-to-follow flowchart style, perfect for connecting concepts quickly when time is tight. So, click the link in the description below to grab yours. For those who want detailed review notes, our Stanley notes are a lifesaver. They go deep into the curriculum while keeping things clear and to the point, so you get maximum understanding in minimum time. No fluff, no unnecessary details, just what you need to pass. All right, let's get to it. Grab your coffee, your calculator, and maybe a stress ball, because we're about to break down CFA Level 3 like never before. So, today's session is about index-based equity investing, a subject that's the backbone for many institutional investors and a must-know for your CFA Level 3 journey. Imagine you're at a buffet. You've got a ton of options, some fancy, some basic, but you're not here to pick the best dish. You're here to get a little bit of everything, right? That's essentially what index-based investing is all about. Or let's put it this way, you're at your favorite burger joint. Instead of customizing every burger from scratch, you choose their signature burger because it's reliable, tasty, and consistent. That's pretty much what index-based investing is all about. Instead of trying to hunt for mispriced stocks like a gourmet chef searching for rare ingredients, you simply replicate a benchmark. Think the S&P 500, Nikkei 225, or FTSE 100. They're like the pulse of the market. It's a rule-based, transparent strategy that aims to replicate the performance of an index without trying to outsmart the market by picking mispriced securities. Now, what kind of indexes are we talking about? Well, you've got your broad market indexes like the S&P 500, the Nikkei 225, and the FTSE 100. These are the big boys, representing a wide swath of the market. Then you've got your factor-specific indexes like the Russell 1000 Growth and Value Indexes, which focus on specific characteristics like growth or value stocks. Why would anyone choose this approach? 3 words: low cost, diversification, and tax efficiency. It's like getting a well-balanced meal without breaking the bank. In this module, we're going to compare factor-based strategies to good old broad indexing. We'll also explore how you can get exposure to these indexes through pooled investments, derivatives, and separately managed accounts. And don't worry, we'll break down portfolio construction techniques with a special focus on controlling tracking error, because nobody likes surprises when it comes to performance. We'll also tackle performance attribution, which is just a fancy way of saying, where did my returns come from? Was it the country, the currency, the sector, the specific security? We'll figure it out. Finally, we'll wrap up with a discussion on portfolio risks and management strategies. So it's time to take it up a notch. This is going to be a fun ride, guys. All right, let's talk about index-based equity investing. This strategy is all about following a rule-based, transparent approach to match index performance. No security picking, no trying to find mispriced stocks, just pure systematic exposure to the market. Now, when you hear index investing, what comes to mind? As I said earlier, maybe the S&P 500, the Nikkei 225, or the FTSE 100. These are broad market indexes that represent a large portion of the market and serve as benchmarks for investors. But there are also factor-specific indexes like the Russell 1000 Growth and Value Indexes, which slice the market in different ways based on specific characteristics of stocks. So the biggest advantages of index investing are its low costs, its built-in diversification, and tax efficiency. But not all index strategies are created equal. Some take a broad approach, simply mimicking the entire market, while others lean into specific factors like momentum or value to seek excess returns. Understanding the differences between these strategies is crucial. Throughout this discussion, we'll explore various ways investors gain index exposure, how portfolio managers construct index-based portfolios, the risks involved, and how tracking error can affect returns. You might have noticed that sometimes an index fund doesn't exactly match the return of the index it tracks. Why is that? That's where tracking error comes in, and we'll break it down in detail a bit later. But first, let's explore different index-based strategies, starting with factor-based investing. Traditional index investing typically involves market cap weighting, meaning stocks are held in proportion to their market values. If Apple makes up 7% of the S&P 500, an S&P 500 index fund will have 7% of its assets in Apple stock. This is a straightforward way to gain exposure to the market, and it essentially rides along with the natural movements of the market. This approach provides what we call beta exposure, returns that come from general market risk, not from picking individual stocks. Factor-based strategies, however, take a different approach. Instead of simply holding stocks based on their market capitalization, factor-based investing selects stocks based on certain characteristics that have historically been linked to excess returns. These factors include value, momentum, quality, low volatility, size, and dividend yield. Factor-based strategies are often referred to as smart beta because they use rules-based approaches to systematically tilt portfolios toward these factors, seeking better risk-adjusted returns than traditional market cap weighted indexes. Now, if traditional market cap weighted indexing is like driving a reliable sedan, factor-based strategies are like souping up that car with a turbocharger. You're still driving a car, but now you've got some extra horsepower under the hood. So let me repeat this. Traditional indexing focuses on replicating market returns, that's your beta, without trying to outperform the market, that's your alpha. It's based on the capital asset pricing model, which is a single factor model. But factor-based strategies, they're all about leveraging multiple factors like size, value, momentum, quality, and volatility to potentially enhance returns. And here's what you need to know. Factor-based strategies maintain the cost efficiency of index funds while giving you exposure to specific factors that drive returns. Think of it as getting the best of both worlds, low costs and the potential for better performance. So market cap weighted indexing is your vanilla ice cream. It aims for market returns, beta, without trying to beat the market. And factor-based strategies is your salted caramel with chocolate chunks. It targets expected returns by emphasizing additional factors beyond beta. When it comes to factor-based investing, there are a few usual suspects, key risk factors that tend to drive stock returns. Let's break them down. A value factor strategy, for instance, tilts towards stocks with low price to book and price to earnings ratios, stocks that are considered cheap relative to their fundamentals. These are your steady Eddie stocks. Think about Warren Buffett's approach. He focuses on undervalued companies with strong balance sheets. A value-focused index might overweight stocks like Coca-Cola or American Express, which have steady earnings but trade at relatively lower valuation multiples. Now, the growth factor, it's about companies with high net income growth and high price to earnings ratios. Think of the tech giants, always growing, always innovating. Now the size factor, it's about smaller market cap stocks. They're like the underdogs, higher potential returns but more volatile. Stocks with high dividend yields, they are perfect for income-focused investors, especially in low interest rate environments. A momentum factor strategy, on the other hand, targets stocks that have been performing well in recent months, betting that trends will continue. This is similar to how some hedge funds operate, piling into stocks like Nvidia and Tesla after their prices have surged. This strategy seeks to capitalize on behavioral finance trends, as investors tend to chase winners. But not all stocks that perform well are high risk. A quality factor strategy prioritizes financially stable companies with strong balance sheets, consistent earnings, and low debt levels. Companies like Microsoft and Johnson & Johnson fall into this category. These businesses tend to be more resilient during economic downturns because they generate reliable profits. Lastly, we have volatility, or rather the lack of it. Some investors seek out stocks with low price fluctuations because they prefer stability and a good night's sleep over market swings. And let's not forget about fundamental factor indexing. Traditional market cap weighting can overweight overpriced stocks and underweight underpriced ones. Fundamental factor indexing avoids this by assigning weights based on fundamentals like book value, cash flow, and sales. It often outperforms cap-weighted indexes with returns largely driven by value and size biases. So what's the bottom line? Factor-based strategies offer a low-cost alternative to traditional active management with the potential for improved performance. But like any strategy, they come with risks. Fundamental factor indexing is all about sidestepping the inefficiencies of traditional market cap weighted indexes. You see, in a typical cap weighted index like the S&P 500, bigger companies get bigger representation, regardless of whether their fundamentals justify that size. But fundamental factor indexing flips that approach. Instead of giving more weight to the largest companies, it assigns weights based on fundamentals like earnings, revenue, or book value. Why does this matter? Well, fundamental indexing often outperforms traditional cap-weighted strategies, especially because it leans into what we call value and size biases. By favoring companies that are fundamentally strong, but maybe not as hyped in the market, it can capture excess returns over time. Think about it. During periods when large cap growth stocks are overheating, a fundamentally weighted approach will naturally tilt towards undervalued, smaller companies that have solid financials but aren't getting as much attention. It's like investing in a solid local coffee shop instead of the big chain. Less flashy, but often with stronger long-term potential. This strategy becomes even more important when you consider how market cap weighting can overexpose a portfolio to overvalued stocks, simply because their prices are high. Fundamental indexing helps avoid this trap, ensuring that investments are grounded in real financial performance. Now that we've set the stage, let's dive deeper into how other strategy classifications work in the real world. First up, let's look at return-oriented strategies, where the primary goal is to maximize gains. One popular approach is the dividend yield strategy. This focuses on companies that consistently pay out high dividends. Think about firms like Coca-Cola, Procter & Gamble, or Johnson & Johnson. These aren't just iconic brands. They've also been paying and growing dividends for decades. An index like the S&P 1500 High Yield Dividend Aristocrats captures these types of companies. For a portfolio manager, investing in these dividend stalwarts is about building reliable income streams for clients who value steady cash flows over speculative gains. Then there's the momentum strategy, which is all about riding the wave of past performance. Imagine the early 2010s when Tesla was skyrocketing. Momentum funds were all in, betting that strong recent returns would continue. And they were right until they weren't. Momentum is about capitalizing on trends, but knowing when to exit is key. Get it wrong, and you can be caught holding a stock that's just fallen off a cliff. But when it's done right, momentum can amplify returns significantly. Finally, we've got fundamental weighting, which is about leaning into companies that may be undervalued based on their core financials, like earnings or book value. This strategy often ends up overweighting smaller companies or value stocks, which might be underappreciated in a cap-weighted index. Think about investing in small regional banks instead of the big players. They might not dominate headlines, but they often have strong balance sheets and local market advantages. When these under-the-radar companies perform well, they can generate outsized returns. Now let's switch gears and talk about risk-oriented strategies, where the focus is on reducing volatility and protecting capital. A common approach here is the low volatility or minimum variance strategy. This means leaning into stocks that historically experience fewer price swings. For instance, companies like Procter & Gamble or Duke Energy. Boring? Maybe. But these companies offer stability. People still need electricity and basic household goods, even when the economy hits a rough patch. During downturns, these stocks don't fall as hard, providing a cushion for portfolios. The goal here is to smooth out returns over time, but it's not foolproof. Just because a stock was low volatility in the past doesn't mean it will stay that way. Take Netflix, for example. It was once seen as a growth powerhouse with relatively stable returns, but as the market evolved and competition increased, its volatility spiked. That's why risk-oriented strategies require constant reassessment. Managers need to stay vigilant, ensuring that their so-called safe picks are still living up to the label. When it comes to diversification, it's about ensuring that no single asset can sink the entire portfolio. One simple approach is equal weighting, where every stock gets the same slice of the pie. This way, you're not overly exposed to any one company. Take a standard cap-weighted index. Companies like Apple or Microsoft can dominate the portfolio. But in an equal-weighted strategy, Apple and a small-cap industrial company might get the same weighting, reducing concentration risk and creating more balanced exposure. For managers who want to go even deeper, there's maximum diversification. This isn't just about spreading investments across different sectors, but about ensuring assets are uncorrelated. Think about it like managing a diversified restaurant business. If you only sell coffee, you're at risk if coffee demand falls. But if you also sell pastries, sandwiches, and salads, you've diversified your risk. Similarly, a portfolio spread across sectors like tech, healthcare, utilities, and consumer staples helps balance out sector-specific downturns. Now, while these strategies sound great in theory, executing them in real life isn't always smooth sailing. One challenge is dealing with multiple benchmarks. Let's say you manage a portfolio based on momentum. You're tracking performance against both a momentum index and a broader market index. If the momentum strategy underperforms, you'll have to explain the tracking error and that can be a tough conversation with investors. Then there's the issue of cost. Factor-based strategies often require more frequent rebalancing and more complex analysis, leading to higher management fees and trading costs. It's like maintaining a luxury car. It performs beautifully, but it's going to cost more to keep it running smoothly. Transparency is another double-edged sword. These strategies are based on clear, rule-based methodologies, which is great for investor understanding. But once a strategy becomes well known, it can lead to crowded trades, reducing potential returns. Think about the rise of ESG investing. When it became mainstream, everyone piled into the same stocks, which eventually led to inflated prices and diminished returns. And let's not overlook factor rotation, where investors switch exposures based on market conditions. While it sounds smart, timing the market is tricky. Get it wrong and you could end up shifting into the wrong factor at the wrong time, missing potential gains or locking in losses. All right, let's keep the momentum going and talk about a topic that often sparks debate in investment circles: active versus passive management. Now, at first glance, factor-based strategies might seem like the poster child for passive investing. After all, they're often built on rules-based systematic processes that aim to capture specific market premiums like value, momentum, or low volatility. But here's the twist. Factor investing isn't as passive as it looks. In fact, it requires some pretty active decision-making right from the start. Think about it like designing a custom meal plan. Sure, once it's set, you can just follow the plan, but up front, you have to decide which nutrients to focus on, how many calories to consume, and how frequently to eat. Similarly, when constructing a factor-based strategy, you have to make active choices: which factor to target, how strong that tilt should be, and what rules will govern the portfolio's rebalancing process. For example, an asset manager might decide to focus on value stocks, leaning towards companies that appear undervalued based on fundamentals like price-to-earnings ratios. That's an active call because it shapes the entire direction of the portfolio. Once those decisions are made, the portfolio can then run on a transparent, rules-based system. Rebalancing happens at regular intervals, ensuring that the portfolio stays true to its factor exposure. But here's where things can get tricky. Just like a diet that needs occasional tweaking based on results, factor-based portfolios may need adjustment if the original strategy isn't delivering the expected outcomes. And that brings us to the risk factor. No strategy is bulletproof. Factor tilts can underperform when the chosen factor falls out of favor. Take momentum, for example. During strong bull markets, momentum strategies can crush it, riding on the coattails of fast-growing stocks. But when market trends shift, those same stocks can become dead weight. A perfect example is the tech crash of 2022, where previously high-flying momentum stocks took massive hits. Investors who were heavily tilted towards momentum suffered significant losses simply because the market narrative had changed. To manage this kind of risk, some investors opt for multi-factor indexing, blending different factor exposures like value, quality, and low volatility to spread the risk. It's like diversifying your meal plan, not just loading up on protein, but also making room for carbs, fiber, and healthy fats. If one element doesn't perform well, the others can help balance it out. In investing, this means that while momentum may be struggling, value or low volatility could be picking up the slack, helping smooth overall returns. All right, let's shift gears and talk about pooled investments. If index-based equity strategies were a restaurant, pooled investments would be the all-you-can-eat buffet. They're the most accessible option for average investors, offering diversification and liquidity without the hassle of managing individual stocks. Think of it like this. Instead of cooking a 10-course meal yourself, you walk into a buffet where everything is already prepared for you. All you have to do is grab a plate and start filling it up. So how do investors actually gain exposure to index strategies? There are several ways, but most choose pooled investment vehicles like mutual funds and exchange-traded funds, ETFs. Instead of manually buying and managing hundreds of stocks, investors can simply purchase shares in a mutual fund or ETF that does all the heavy lifting for them. Mutual funds and ETFs both track indexes, but they function differently. Mutual funds allow investors to buy and sell shares at the fund's net asset value, NAV, which is determined at the end of each trading day. ETFs, on the other hand, trade like stocks, meaning investors can buy and sell them throughout the day at market prices. Mutual funds have been around since the 1970s, and they're like the granddaddy of pooled investments. The Vanguard S&P 500 Index Fund, launched in 1975, is one of the most famous examples. It's designed to track the S&P 500, giving investors exposure to 500 of the largest U.S. companies without having to buy each stock individually. Here's how it works in real life. Imagine you're an investor who wants to own a piece of companies like Apple, Microsoft, and Amazon, but you don't have the time or capital to buy shares in each one. Instead, you buy shares in the Vanguard S&P 500 Index Fund. The fund pools money from thousands of investors like you and uses it to buy all 500 stocks in the S&P 500. You get instant diversification, and all you have to do is sit back and let the fund manager handle the rest. But mutual funds aren't just about convenience, they're also heavily regulated. In the US, they follow the Investment Company Act of 1940, which sets rules around transparency, fees, and investor protections. In Europe, many mutual funds adhere to UCITS, Undertakings for Collective Investment in Transferable Securities provisions, which are designed to protect retail investors. Now, let's talk about the costs and benefits. On the cost side, mutual funds come with expenses like registration fees, custodial fees, and audit fees. These costs are passed on to investors in the form of an expense ratio, which is a percentage of your investment that goes toward covering the fund's operating expenses. For example, the Vanguard S&P 500 Index Fund has an expense ratio of just 0.04%, which is incredibly low compared to actively managed funds that can charge 1% or more. On the benefits side, mutual funds offer professional management, diversification, and ease of use. You don't have to worry about rebalancing your portfolio or keeping up with corporate actions like stock splits or dividend payments. The fund manager handles all of that for you. And of course, they are low in cost. Now, let's talk about ETFs, or exchange-traded funds. If mutual funds are the granddaddy, ETFs are the cool younger sibling who shows up to the family reunion with a Tesla and a smartphone full of crypto apps. ETFs were introduced in Canada in 1990 and hit the US market in 1993. Today, they're one of the most popular investment vehicles for both retail and institutional investors. Here's how ETFs work in the real world. Let's say you're interested in investing in the technology sector, but you don't want to pick individual stocks like Apple, Google, or Tesla. Instead, you buy shares in the Invesco QQQ ETF, which tracks the NASDAQ 100 index. This ETF gives you exposure to 100 of the largest non-financial companies listed on the NASDAQ, all in a single trade. One of the biggest advantages of ETFs is their tax efficiency. Unlike mutual funds, which may have to sell securities to meet redemptions, triggering capital gains taxes, ETFs use an in-kind creation and redemption process. Here's how it works. When an investor wants to redeem shares, the ETF doesn't sell the underlying securities. Instead, it delivers a basket of stocks to the redeemer. This process minimizes taxable events, making ETFs a favorite among tax-conscious investors. Another advantage is trading flexibility. ETFs trade on stock exchanges like individual stocks, so you can buy and sell them throughout the trading day at market prices. This is a big deal for investors who want to react quickly to market movements. For example, following the COVID-19 market meltdown in March 2020, many investors used ETFs to immediately change their portfolios, dumping broad market ETFs and purchasing sector-specific ETFs such as the Healthcare Select Sector SPDR Fund, XLV, to capitalize on the spike in healthcare stocks. But ETFs aren't without their drawbacks. For one, they come with trading cost. Every time you buy or sell an ETF, you pay a commission, unless your broker offers commission-free trading. There's also the bid-ask spread, which is the difference between the price you can buy an ETF for and the price you can sell it for. For highly liquid ETFs, the spread is tiny, maybe a penny or two. But for less liquid ETFs, the spread can be much wider, eating into your returns. So how do you decide between mutual funds and ETFs? It really comes down to your investment goals and trading behavior. If you're a long-term investor who values simplicity and doesn't plan to trade frequently, mutual funds might be the better choice. They're easy to buy, require minimal maintenance, and are great for dollar cost averaging, investing a fixed amount at regular intervals. For example, the Vanguard S&P 500 Index Fund is a mutual fund that passively tracks the S&P 500. If you invest in it, your money is pooled with that of other investors, and the fund buys all 500 stocks in the index to match its performance. On the other hand, if you're a more active investor who wants flexibility, tax efficiency, and the ability to trade throughout the day, ETFs are probably the way to go. They're also a great option for investors who want to target specific sectors or factors. For instance, if you believe renewable energy is the future, you could invest in the iShares Global Clean Energy ETF, ICLN, which holds companies like Tesla, Enphase Energy, and Vestas Wind Systems. Similarly, the SPDR S&P 500 ETF does the same thing, but it trades on an exchange, allowing investors to buy and sell it like any other stock. One key difference, ETFs are generally more tax efficient than mutual funds. Why? Because of how redemptions work. ETFs use in-kind transfers, which help minimize capital gains distributions. ETFs also offer more flexibility as they can be traded throughout the day, unlike mutual funds. However, they come with bid-ask spreads, meaning investors might pay slightly more than the actual NAV when buying or receive slightly less when selling. When it comes to cost, ETFs usually have lower expense ratios than mutual funds. This makes them attractive for cost-conscious investors who want index exposure with minimal fees. However, for long-term investors who prefer simplicity, mutual funds might still be the better choice, as they don't require worrying about bid-ask spreads or trading commissions. Another interesting development in index investing is the rise of factor-based ETFs. These ETFs allow investors to gain exposure to specific investment factors like value, size, momentum, or quality. They provide a convenient way for investors to implement factor-based strategies without having to manually select individual stocks. Over the past decade, factor-based ETFs have exploded in popularity. Institutions and retail investors alike have embraced these funds as an alternative to traditional passive investing. While factor-based investing was once only available to sophisticated quant funds and hedge funds, it's now accessible to anyone with a brokerage account. ETFs and mutual funds each have their place in an investor's toolkit. Choosing between them depends on the investor's time horizon, trading preferences, and tax considerations. Regardless of the vehicle, index-based investing remains a powerful tool for building diversified, cost-efficient portfolios. All right, let's talk about an interesting way investors can get exposure to an index without actually buying the individual stocks, derivatives. Now, I know derivatives can sound intimidating, but stick with me. Instead of putting up the full capital to buy, say, all the stocks in the S&P 500, investors can use tools like futures, swaps, and options to mimic index returns. Sounds efficient, right? It is, but of course, nothing in finance is free of risks and complications. Think of derivatives as a shortcut to market exposure. Instead of directly replicating an index or investing in an ETF, fund managers can use futures or swaps to quickly gain exposure to an index without the hassle of managing individual securities. This approach is widely used by institutional investors who need flexibility, lower transaction costs, and the ability to leverage their positions. Imagine a pension fund that needs to adjust its portfolio exposure to match a benchmark but doesn't want to execute hundreds of individual trades. By using an equity index swap, the fund can agree with a counterparty to receive the return of the index while paying a floating rate, essentially getting the same market exposure in a single transaction. Easy, right? Well, not so fast. Derivatives come with their own set of complexities. One of the biggest draws of derivatives is their cost effectiveness. Unlike buying a full basket of stocks, which requires significant capital, derivatives allow you to get exposure with only a fraction of the cost. Plus, they provide leverage, meaning you can control a much larger notional value than your initial investment. This is why hedge funds love them. They can amplify their bets without tying up too much cash. But here's the flip side. Leverage cuts both ways. If the market moves against you, losses can mount quickly. So, folks, leverage is a double-edged sword. Just as it magnifies gains, it magnifies losses. If markets move against you, you might face margin calls, requiring you to inject more cash into your position. This is exactly what happened in 2021 to Archegos Capital Management, which used swaps to gain leveraged exposure to tech and media stocks. When the market turned, margin calls wiped them out, causing $20 billion in losses across multiple banks. And then there's counterparty risk. Not all derivatives are traded on exchanges. Over-the-counter instruments like swaps expose you to the possibility that the other party might not hold up their end of the deal. Futures and options, on the other hand, are exchange-traded and cleared through intermediaries, reducing that risk. Another thing to watch out for is expiration risk. Unlike holding an index ETF forever, derivatives have an expiry date. If you want to maintain exposure, you need to roll over your contracts before they expire. That means transaction costs, potential price slippage, and if you're dealing with futures, margin calls that demand more capital if markets move the wrong way. This process isn't free. It incurs transaction costs and potential tracking error. If the market is volatile, rolling contracts forward can lead to unexpected losses. Something commodity traders learned the hard way in April 2020 when U.S. crude oil futures went negative for the first time in history. To mitigate these risks, institutional investors diversify their approach, using a mix of futures, swaps, and direct stock holdings to balance exposure, costs, and risk. But it's not just about gaining exposure. Derivatives are also used for portfolio overlays. Let's say you're managing a $10 billion pension fund. Some of that money is invested in equities, some in bonds, and some held in cash. But holding cash creates a problem. It doesn't generate returns, meaning you're underperforming your benchmark. This is where derivatives overlays come into play. Now, if you're thinking derivatives are just for Wall Street traders in fancy suits making million-dollar bets, think again. Portfolio managers use them all the time to fine-tune their exposures. Ever heard of a completion overlay? It's a fancy term for when a manager uses derivatives to adjust their portfolio to match a benchmark. Let's say a portfolio has some excess cash. It's not fully invested in the index yet. Instead of buying stocks, the manager can use index futures to quickly bring the portfolio in line with its target allocation. Another common use case, rebalancing overlays. Picture this, a pension fund has a stock-to-bond ratio of 60-40, but after a strong equity rally, the portfolio is now 65% stocks. Rather than selling stocks, which could trigger capital gains taxes, the fund could use equity index futures to offset the excess exposure temporarily. And let's not forget about currency overlays. If you're investing internationally, currency fluctuations can be a headache. A European investor holding US stocks might see their returns affected by changes in the euro-dollar exchange rate. To hedge against this, they could enter a currency swap, effectively locking in their home currency's value against their investments. Okay, now let's talk about equity index derivatives, futures versus swaps. When it comes to derivatives used in index investing, two big players stand out, futures and swaps. Both serve the same goal, providing index exposure. But they work differently. Futures are standardized contracts traded on exchanges. They're super liquid, easy to access, and settle in cash, which makes them popular for portfolio managers who want quick exposure. For example, an S&P 500 futures contract might have a multiplier of $250 per index point. If the index moves up by 10 points, that's a $2,500 gain per contract. But here's the issue. Since futures operate on margin, you only put up a fraction of the notional value, giving you leverage, but also increasing risk. Swaps, on the other hand, are private agreements between two parties. They're flexible, allowing customization of contract terms like the underlying index, notional amount, and duration. Let's say a fund manager wants exposure to the Euro Stoxx 50, but doesn't want to deal with the hassle of buying European stocks. They can enter into a swap where they receive the index return and pay a floating interest rate. Simple, right? The drawback? Since swaps aren't traded on exchanges, they come with counterparty risk. If the other party defaults, you're in trouble. Next up, separately managed index-based portfolios, the operational side. Now, if you're a fund manager looking to replicate an index the traditional way, actually buying and holding the stocks, you've got some work to do. Managing an index-based portfolio isn't just about picking the right stocks. It involves sophisticated infrastructure, accurate data, efficient trading systems, and regulatory compliance. First, you need up-to-date index data. This means subscribing to data feeds from index providers like S&P Dow Jones, MSCI, or FTSE Russell. These feeds provide critical details like security identifiers, dividend adjustments, and corporate actions. Think mergers, acquisitions, stock splits. You also need a robust trading system that allows you to compare your portfolio to the benchmark and execute trades efficiently. Then there's the brokerage aspect. If you're trading in high volumes, your execution costs can add up. Fund managers negotiate with brokers to get lower commissions, which directly impacts performance. And of course, compliance is crucial. Regulatory rules can restrict what you can trade, and internal policies might prevent you from executing certain trades due to conflicts of interest. Compliance is also a huge factor. Large funds need robust risk controls and regulatory oversight to ensure they don't breach investment mandates, margin limits, or tax policies. That's why managers spend millions on portfolio monitoring software and compliance tools. A single violation can lead to hefty fines and reputational damage. Compliance teams monitor activities in real time to prevent violations, as penalties for noncompliance can be severe. A major example was Robinhood's $70 million fine in 2021, where regulators penalized the company for failing to protect customers from trading risks. While that case was in brokerage, similar regulatory failures in portfolio management can lead to significant fines, reputational damage, and even lawsuits. And then comes the important process: performance monitoring and rebalancing. Keeping the portfolio on track. Running an index-based portfolio isn't a set-it-and-forget-it operation. A manager must regularly rebalance the portfolio to account for index changes, corporate actions, and dividend reinvestment. Best practice? Monitor daily, rebalance when needed, and conduct a deep dive at least monthly to ensure tracking error remains minimal. When an index provider like Russell 2000 updates its index in June, billions of dollars move into newly included stocks, requiring index funds to adjust their holdings accordingly. Portfolio managers also use program trades, which allow them to buy or sell large baskets of stocks in a single transaction, reducing operational complexity and market impact. One often overlooked aspect is dividend reinvestment. Over time, uninvested dividends can create cash drag, pulling returns slightly below the index. Managers must reinvest dividends efficiently to maintain alignment. Another challenge: managing tracking error. Even minor slippages in stock selection or execution prices can lead to deviations from the benchmark. The tighter the tracking, the better. A fund tracking the S&P 500, for example, might receive hundreds of millions in dividends every quarter. If that cash isn't reinvested efficiently, the fund could underperform the index. Managers must decide whether to reinvest dividends immediately, quarterly, or on a fixed schedule, balancing the need to minimize cash drag while ensuring sufficient liquidity for withdrawals and expenses. A great example is Norway's government pension fund, which holds a massive stock portfolio designed to mirror global equity markets. To keep tracking error low, they must continuously rebalance holdings, reinvest dividends, and adjust for corporate actions. All right, let's wrap this up. When it comes to derivatives-based indexing, the key things to remember are why derivatives are used: cost, efficiency, flexibility, the risks they introduce, leverage, counterparty, and expiration risks, and how portfolio managers use them for completion, rebalancing, and hedging. If you're tackling CFA Level 3's essay questions, expect scenarios where you have to analyze whether derivatives or direct replication makes sense in a given context. Be ready to explain margin requirements, counterparty risk and swaps, and how rolling futures contracts impact exposure. For item set questions, pay close attention to the mechanics of futures contracts. Things like notional value calculations, margin calls, and basis risk. Be prepared to explain why an investor might choose swaps over futures, how margin accounts work, and how overlays can enhance portfolio management. Also, expect questions testing your knowledge of counterparty risk, basis risk, and expiration risks in derivative strategies. All right, let's talk about how portfolio managers actually go about building an index-based equity portfolio. This isn't just about buying a bunch of stocks and hoping for the best. There's a science and a bit of art to it. When you're managing an index portfolio, you're walking a tightrope. You want to track the index as closely as possible while keeping costs low. So, how do you do that? Well, portfolio managers typically rely on three main approaches: full replication, stratified sampling, and optimization. Each method has its own strengths and trade-offs, depending on factors like portfolio size, liquidity, and transaction costs. Let's break them down. If you want your portfolio to mirror an index down to the last detail, full replication is your best bet. This means holding every single stock in the index in exactly the same proportion as it appears in the benchmark. Sounds simple, right? Just buy everything and match the weights. And in theory, it is. Full replication ensures that your portfolio's performance is nearly identical to the index. Low tracking error, easy to explain to clients, and no surprises. If the S&P 500 is up 10%, your portfolio is up 10%. If it's down 5%, well, you know the rest. But here's the catch. This method isn't cheap. First off, you need a massive asset base to pull this off. If you're a small fund, you might not have enough cash to buy all the stocks in a major index, especially if some of them are expensive. Then there's the issue of illiquid stocks. Some companies in broad indexes barely trade, and buying them can jack up your trading costs. Think about an index that includes both Apple, super liquid, trades millions of shares daily, and some tiny company with barely any volume. To match the index precisely, you'd have to buy both, but placing an order for that illiquid stock could push up the price, leading to higher costs. That's why full replication can be expensive, especially in indexes with a lot of small or thinly traded stocks. There's also something called the U-shaped relationship between tracking error and transaction costs. Basically, as you add more stocks, your tracking error goes down. Good. But once you start buying illiquid stocks, your costs start rising. Bad. So, while full replication keeps you closely aligned with the index, it's not always the most cost-efficient strategy. Now, what if full replication is just too expensive or impractical? That's where stratified sampling comes in. Instead of holding every stock in the index, you group stocks into key categories. Things like industry sector, company size, equity style, growth versus value, or country exposure. Then you select a representative subset from each category rather than buying everything. Let's say you're tracking the MSCI World Index, which includes thousands of stocks across dozens of countries. Instead of buying every single stock, you could divide the index into regional buckets: US, Europe, Asia, etc. Then further segment it by sector, tech, financials, healthcare, and pick a few stocks from each group that closely represent the whole. This method keeps transaction costs lower because you're not constantly trading tiny illiquid stocks, and it still gives you a broad exposure that approximates the index's characteristics. It's especially useful for funds with smaller asset bases or those tracking multi-country indexes where trading costs could be high. But of course, it's not perfect. Because you're only holding a fraction of the actual index, your tracking error will be slightly higher than with full replication. Also, this approach doesn't explicitly account for correlations between individual stocks. So while you're capturing broad index characteristics, you might miss some nuances that affect performance. If full replication is too expensive and stratified sampling isn't precise enough, we step into the world of optimization. This approach uses historical data, returns, variances, covariances, to build a portfolio that mimics the index as closely as possible, but with fewer stocks. Think of it as stratified sampling, but with a mathematical backbone. Portfolio managers set specific constraints, like we don't want to hold more than 50 stocks, or let's match the index volatility but avoid certain sectors. The optimization model then crunches the numbers and selects the best combination of stocks to minimize tracking error while keeping costs under control. This approach is a game changer for funds that can't afford full replication but still want tight tracking. It explicitly considers relationships between stocks, which helps it achieve lower tracking error compared to stratified sampling. But, and this is a big but, it relies on historical data. And we all know past performance isn't always indicative of future results. Markets evolve, correlations shift, and what worked last year might not work next year. This means frequent reoptimization is required, which can drive up trading costs and make portfolio management more complex. And now the blended approach, the best of both worlds. In reality, most fund managers don't stick to just one of these methods. Instead, they mix and match to get the best outcome. A common strategy, full replication for the largest, most liquid stocks, and then either stratified sampling or optimization for the smaller, illiquid ones. Let's take an index with 500 stocks, where the top 100 stocks account for 80% of the total weight. A blended approach would fully replicate those 100 stocks since they're liquid and easy to trade, then use either stratified sampling or optimization to approximate the remaining 400. This way you get the accuracy of full replication for the big names while keeping trading costs low for the smaller stocks. This method works well for broad indexes with a mix of liquid and illiquid securities, balancing precision and cost efficiency. So, for CFA Level 3, guys, this is a key exam topic. Expect constructed response, essay-type questions asking you to compare these approaches based on a given scenario. You might get a case where a portfolio manager is trying to balance tracking error and costs. Your job is to justify which approach makes sense and why. On the multiple choice side, be ready for item set questions testing your understanding of how tracking error, transaction costs, and liquidity impact index replication. At the end of the day, index portfolio construction is all about making smart trade-offs. Whether you go for precision, efficiency, or a blend of both, the goal is always the same: tracking the index as closely as possible while keeping costs under control. Now, go practice some questions, and remember, the CFA exam doesn't just test what you know, it tests how well you can apply it. But hey, wait, first finish this module. So let's move on to the next section. Next up, tracking error management. A crucial topic, especially for those working with passive investment strategies. Managing an index fund isn't just about buying all the stocks in an index and calling it a day. In reality, keeping a portfolio perfectly in sync with its benchmark is a constant challenge, and that's where tracking error comes in. Tracking error and excess return, what are they? Let's explore. In passive investing, the goal is to mirror the benchmark as closely as possible, but in the real world, portfolios never match the index perfectly. That's why we measure two key things. First, we have excess return, which is simply how much extra return or underperformance the portfolio has relative to the benchmark. If your index fund returns 8% while the benchmark returns 7.5%, your excess return is 0.5%. Simple, right? Then there's tracking error, which tells us how consistently a portfolio follows the benchmark over time. Think of it like driving on a highway. If you're sticking right in your lane, tracking error is low. But if you're drifting slightly left and right, tracking error increases. It's calculated as the standard deviation of the difference between portfolio returns and benchmark returns. But in plain English, it's just a measure of how far your portfolio's returns tend to stray from the index. Tracking error is always a non-negative number, meaning it can't be negative because it's based on squared deviations. And it depends on several factors: how often you measure it, how many stocks are in the portfolio, and how long you track performance. What causes tracking error? Even the most well-managed index funds have some level of tracking error. Why? Because of real-world constraints that make perfect replication impossible. Let's go over the main culprits. Number one is fees, the silent performance killer. Every fund has management fees and operational costs, but the benchmark doesn't. These costs directly reduce the fund's return, which means even if the fund perfectly tracks the index before fees, it will always underperform slightly after fees. The higher the fees, the higher the tracking error. Some funds don't fully replicate an index because holding every single stock can be too expensive, especially for broad indices like the Russell 3000 or MSCI All Country World Index. Instead, funds might hold a representative sample of stocks that closely match the index risk and return profile. While this reduces costs, it also increases tracking error because the portfolio isn't an exact match. And then is timing of trades. Here's a real-world problem. Index values are based on closing prices, but portfolios trade stocks throughout the day. If a manager buys or sells stocks at different times than the official closing price, small price differences add up over time, leading to tracking error. This is especially noticeable during high volatility periods when prices swing dramatically between market open and close. Then are commissions and trading costs. Every time a portfolio manager buys or sells stocks, they incur trading commissions and other costs. The more a portfolio trades, the more these costs chip away at returns, widening the gap between the portfolio and the benchmark. To minimize this, many index funds execute trades at the end of the day or use algorithmic trading to reduce costs. Cash drag. It's the hidden performance drag. Index funds often receive dividends, investor inflows, or proceeds from stock sales. But until that cash is reinvested, it sits in the portfolio doing nothing, causing what's known as cash drag. Think about this. If the market is rising, holding cash means the fund underperforms because cash isn't growing like the stocks in the index. If the market is falling, cash helps cushion losses, making the fund temporarily outperform. Either way, cash holdings introduce tracking error. To minimize this, fund managers often equitize cash by using futures contracts, ETFs, or swaps, keeping the portfolio fully invested and reducing tracking error. How do managers control tracking error? Since eliminating tracking error completely is impossible, the goal is to keep it as low as possible while balancing costs. One strategy is to invest new cash flows with a target beta of 1, meaning the new investments should have the same level of risk as the benchmark. This helps prevent cash from distorting the portfolio's risk-return profile. Another approach is using derivatives like futures and ETFs to quickly adjust exposure without excessive trading costs. Instead of buying every single stock immediately, managers can use index futures to gain exposure and gradually buy stocks over time. Finally, managers consider the trade-off between tracking precision and transaction costs. For instance, holding more stocks reduces tracking error but increases trading costs. So, folks, holding fewer stocks lowers costs but increases tracking error. So, bottom line, finding the right balance is key. Now, you might be thinking, why does this matter in the real world? Tracking error isn't just an academic concept, it has real-world implications for fund managers and investors. Take two of the biggest S&P 500 index funds, Vanguard's VOO and SPDR's SPY. Both track the same index, yet their returns aren't identical. Why? Differences in fees, cash management, and trading execution create small variations, leading to tracking error. For institutional investors managing billions, even a 0.1% tracking error can mean millions of dollars in unexpected performance differences. That's why large pension funds and endowments closely monitor tracking error when selecting index funds or ETFs. Okay, now let's move to the last section, the sources of return and risk in index-based equity strategies. Now, if you're managing an index fund, you might think it's just about buying every stock in the index and going on autopilot. But even passive investing has layers of complexity that can affect performance. And understanding these nuances is critical, not just for the exam, but also for real-world portfolio management. Let's start with attribution analysis, which is basically the art of figuring out where returns are coming from. Imagine you're running an index fund tracking the S&P 500. Over the past year, your fund is up 10%, but is that just because the overall market performed well? Or did specific sectors or stocks drive the gains? That's where attribution analysis comes in. It helps you break down company-level returns, sector trends, country-specific effects, and even currency movements to pinpoint what really moved the needle. Think of it like running a restaurant. If your total sales go up by 10%, you'd want to figure out why. Did you introduce a new best-selling menu item that customers can't get enough of? That would mean the growth is coming from a specific dish's success. Or maybe the entire plant-based burger trend exploded, and since you offer those on your menu, sales surged across the board, meaning the boost came from a broader industry trend rather than just your restaurant. It could also be that you opened a new location in a high-demand city where customer traffic is naturally stronger, driving overall sales higher. And let's not forget currency effects. If the local exchange rate made dining at your restaurant cheaper for tourists, that could have also played a role. Now, take that same logic and apply it to portfolio returns. If an index fund is up 10%, what's driving that growth? It could be because one particular stock in the portfolio, let's say Nvidia, had a breakout year. Or maybe an entire sector, like technology, rallied, lifting multiple stocks at once. Another possibility is that investing in emerging markets paid off. And of course, currency movements can impact portfolio returns too. If the fund holds international stocks and the local currency strengthens, it can increase overall returns. By breaking down returns in this way, whether in a business or an investment portfolio, you can see the real drivers behind performance instead of just looking at the top line numbers. Now, in the CFA exam, you might be given a portfolio's return breakdown and asked to attribute performance. Let's say you're analyzing a European equity index fund and it's up 7% this year. If the euro appreciated against the dollar, that might account for 2% of the gain, while sector-specific growth in technology stocks might have added another 3% and so on. Understanding these factors isn't just academic. It's what fund managers do every single day to explain performance to clients and stakeholders. But returns aren't the only story. Risk is just as important. Even in a passive strategy, you need to understand what can go wrong. Holding an index fund means you're exposed to market risk, but also sector concentration risk. For instance, in 2023, tech stocks like Nvidia, Microsoft, and Apple accounted for a massive portion of the S&P 500's gains. If your index fund is overweight in tech simply because the market cap of those stocks is growing, then a market correction in tech could drag down your portfolio significantly. So, folks, remember, when it comes to index investing, not all portfolios are built the same way. Some funds focus on high dividend yield stocks designed to attract investors looking for consistent income, much like retirees who rely on dividend payouts as a steady cash flow. Others are structured as low volatility portfolios aimed at reducing sharp price swings. Think of them as the steady, reliable players in the investment world, similar to how a well-diversified business doesn't experience extreme ups and downs in revenue. This is where attribution analysis becomes a powerful tool, helping fund managers understand exactly what's driving returns. Whether it's dividends, low-risk stability, or exposure to specific market factors, analyzing these elements ensures that a fund isn't just tracking the market, but delivering on its investment objectives. For CFA Level 3 exam, expect to see attribution-based questions that require you to break down portfolio performance and assess whether returns are coming from intended strategies or unintended risks. Now, let's talk about securities lending, which is one of the few ways an index fund can actually outperform its benchmark. This is a behind-the-scenes strategy that can generate extra income for index funds without taking on additional market risk, at least on the surface. Here's how it works. When an investor or fund holds securities, they don't just let them sit idle. They can lend them out to short sellers who need to borrow shares to make their trades. This process is handled by a lending agent, which can be the fund's custodian or an asset management firm specializing in securities lending. Before any transaction takes place, two key agreements come into play. First, the Securities Lending Authorization Agreement formalizes the relationship between the lender and the agent, while the Master Securities Lending Agreement sets the terms between the lending agent and the borrower. Now, when a borrower takes the shares, they have to provide collateral, typically valued at 102% to 105% of the borrowed securities. This collateral can be in the form of other securities or cash, ensuring the lender is protected. If securities are used as collateral, their value is marked to market daily, meaning they are constantly reassessed to ensure the lender is covered. If cash is used, the lending agent doesn't just let it sit. They invest it in highly liquid assets, earning interest, a portion of which is rebated back to the borrower. Imagine your index fund owns shares of Tesla, and a hedge fund wants to short Tesla stock because they believe its price will drop. They need to borrow those shares to sell them in the market, and your fund can lend them out in exchange for a fee. Essentially, your fund is making money just by temporarily loaning shares it already owns. Securities lending sounds like easy money, but there's always a catch. One major risk is collateral reinvestment risk. The borrower typically provides collateral, and the fund often reinvests that collateral in short-term liquid assets. But what if those short-term investments lose value? Now, instead of earning risk-free income, your fund is exposed to losses. There's also counterparty risk. What if the borrower goes bankrupt and can't return the shares? Yes, collateral helps protect against this, but if markets are in chaos, it might not be enough. Remember Lehman Brothers? Before its collapse in 2008, many funds had lent securities to it, assuming the collateral was safe until it wasn't. On your CFA exam, you might be asked to assess whether securities lending is appropriate for a given portfolio. A low-cost index fund looking to improve tracking error might benefit from it, but a highly risk-averse pension fund, maybe not, especially if their primary goal is capital preservation. One final wrinkle: when a stock is lent out, the borrower gets all the voting rights. That means if an index fund lends out too many shares before a crucial shareholder vote, it loses its ability to influence corporate governance. So fund managers need to balance the extra income from lending securities against their role as long-term shareholders. Now, let's talk about something you might not expect when thinking about passive investing: shareholder activism. If an index fund is designed to just track the market, why would it care about corporate governance? The answer lies in the sheer size and influence of today's biggest index fund managers. Firms like BlackRock, Vanguard, and State Street own massive stakes in almost every major company. That means they have voting power, and lots of it. For example, in 2021, a group of activist investors challenged ExxonMobil's board, pushing for more climate-friendly policies. Who had a major say in the outcome? Index fund giants. Because they own large portions of companies they track, their votes can change the direction of corporate strategy. But here's the dilemma. Unlike active investors, index funds can't just sell a stock if they don't like how a company is being run. If Meta, formerly Facebook, faces governance scandals, an active investor might dump the stock and move on. But if you're running an S&P 500 index fund, you have no choice but to keep holding it unless Meta is removed from the index. That's why large index fund managers take corporate engagement seriously. They meet with CEOs, vote on board decisions, and push for better governance. However, engaging in corporate governance costs money. It requires dedicated research teams, meetings with executives, and active monitoring of issues like executive compensation, environmental impact, and board independence. In the CFA exam, you might see a question asking whether an index fund should increase its governance efforts or minimize costs and remain neutral. The best approach usually lies somewhere in the middle. Index funds need to engage enough to protect long-term shareholder value without driving up costs unnecessarily. Managing an index fund might seem straightforward, but as we've seen, there's a lot more going on under the hood. You need to understand where returns come from, how risks creep in, and the strategic decisions managers must make. So let me quickly highlight a few key takeaways for you to remember. Attribution analysis helps break down returns into company performance, sector trends, country effects, and currency movements. Expect to see case study questions where you'll need to analyze a portfolio's return drivers. Securities lending is a revenue booster, but it comes with risks like counterparty default and collateral reinvestment issues. Be ready to evaluate whether a given portfolio should engage in lending activities. Index fund managers play a surprisingly active role in corporate governance. Since they can't sell underperforming stocks, they must use voting power and engagement strategies to drive better long-term outcomes. Governance efforts come with trade-offs. Engaging in shareholder activism requires resources, but ignoring governance completely can hurt long-term returns. Be prepared to discuss cost-benefit trade-offs on the exam. All right, that wraps up today's lecture. Now, before you go, let me remind you, these battle-ready summaries you see on your screen, they're not just for this topic. They're available for all CFA Level 3 learning modules. Whether you're tackling portfolio management, fixed income, or derivatives, these summaries are your secret weapon for cutting through the noise and focusing on what truly matters. And the best part? You can download and print them so you have them handy whenever you need a quick refresh. Perfect for last-minute review before exam day. So don't wait. Go grab them now. The link is in the description. All right, keep pushing forward, stay focused, and I'll see you in the next lecture. Let's get you CFA battle ready.